All right, we are still on chapter 6, and we are talking about some special issues in regards to step 3, determine the transaction price. So just a quick review. Here are our 5 steps. We're right here talking about some special things that go on in that step 3 process. Okay, so we could have variable consideration. There could be some constraints on the recognition. Is there any sales with a right to return? So you find that a lot, like college textbook stores where they have the right to return so many of those textbooks. Um, Maybe trying to identify if it's a principal or agent that you are dealing with. You could be using some time value of money issues, especially if this contract goes like over a year, 2, 3 years, then you probably want to um, pull some of that back to present value to find out how much that transaction is. And then everything else is just interest. Okay. And then payments to the seller. Okay. Some of those variable considerations, it could be under construction. You may have some sort of incentive to finish a project early. They'll pay you like a bonus. And in some cases, like if they go over, like so much some construction company has to pay you so much if they go over and it lasts a long time. Royalties, entertainment media, they get royalties from the movies, different things that they create. Okay. Healthcare, Medicare, Medicaid reimbursements, manufacturing, we could get some volume discounts, and it could be some rebates. Okay. Two ways that we will estimate the transaction price. We will do the expected value or most likely amount. So they give us an example here, and this is True Tech. True Tech enters into a contract with Pro Sports to add Pro Sports online games to the TriNet network. Pro Sport offers popular games like Brawl of Bands, wants those games offered on the TriNet. So Pro Sport can sell gems, weapons, health potions, and other game features that allow players to advance more quickly. Okay. So upfront, January 1st, Pro Sports is going to pay $300,000 for that 6 months. Okay. They are also will pay 180,000 bonus if TriNet Access Sports games at least 15,000 hours during that 6 month period. So yay. So we have the possibility of 300,000, making 300,000, and then the possibility of 480,000. Okay. So they tell us that there's a 75% chance that it will achieve the usage target of 180,000. Okay. So just mathematically, if we take the 75 away from 100% chance, then we have a 25% chance that it will only be the 300. Okay. So first thing we're going to do is make the journal entry for that cash and defer that revenue of 300,000. Okay. Here's our first alternative in using what we call the expected value. So I did that little 25% over there because it was right there, 25% or the 75. And that way you kind of knew, because as I was looking over these slides before did this lecture, I was like, where'd that 25 come from? Oh, okay, it's the 100 minus 75. They didn't necessarily tell us that. They just assumed that you knew there was a 25% chance that they would not uh, get the 300,000. So 75% times 300, 480,000 gives us 360. Then 300,000 multiplied times at 25% is 75%. So our expected value on the contract price at the inception would be 438,000. Okay. Here we are going to use the most likely amount. Okay. Most likely amount was the 75% that we would get that. Okay. We've already made the journal entry to get the cash for the 300,000. Okay. So let's kind of break it down. We're looking at adjusting that first. And this 80,000 is part of the adjustment of 50,000. And then what we expect to get, that 180,000 divided by 6 months, is that 30. Okay. This we've already gotten. We know we're going to get that 50,000. Okay. But right now at this point, we assume that we are going to make that bonus of 180,000. So you can see how we are recording revenue, 80,000 every single month. We were debiting the bonus receivable, 30,000 for 6 months. That's the 180. That way, if we already have that receivable because they weren't going to pay us till the end, um, assume that they paid us. We did make it over 15,000 hours. We've got another one that we're going to do that it didn't. So just trying to clarify which one of these and kind of separate them out. Okay. So that's where the 80,000 come from. It's just really the 50 and the 30. We've already gotten the 50,000. We've already gotten all of that in cash. We haven't gotten the bonus receivable. We won't get that till the end. Okay. All righty. So then let's assume that we're still underneath that if most likely amount. If True Tech receives the bonus, then at the end, they're going to debit cash, credit the bonus receivable. If True Tech does not receive the bonus, they are going to take that out of the service revenue, that 180,000. See, that's really weird. You're debiting service revenue, so because you're decreasing it. You're crediting the receivable to get rid of it. Okay, to get it out of there. All right. And then now we're going to assume that after 3 months, TrueTech concludes that due to low usage of pro sports games, most likely will not get the 180,000 bonus. Well, after 3 months, we've already recorded 30,000 for 3 months, so that's a total of 90. We are going to debit that service revenue account and credit the bonus receivable. Okay. And then after that, we would be making the entry just for the 50,000 for those 3 months that follows that. Okay. All right. I'm going to skip past those so that we can get through this video. All right. A lot of times there's going to be disclosures on things like contracts, and especially contracts with like major customers. So they may disclose, here's the expected value, here's what's going on in the notes to the financial statements. Okay. All right, some special issues with step 3, constraint on recognizing variable consideration. So some indicators may be poor performance on which to base the estimate, dependence on an estimate on factors outside of the seller's control. Okay, something outside of the seller's control. I mean, the economy could just go down and we could, hit a recession. That's outside of the seller's control. History of the seller changing the payment terms on similar contracts. We could have a broad range of outcomes. We just had 2 in the previous one. We could have lots and lots of different ones. Okay. And there could be long delay before any uncertainty resolves. Okay. All right. So now we're going to assume that TrueTech can't conclude that it is probable that a significant revenue reversal will not occur in the future. Then they are constrained from recognizing any of that 150,000. Okay. So TrueTech will only include that upfront payment of the 3,000, dividing that out and making that journal entry every single month for 6 months. Okay. Now, let's assume that on April 1st, after 3 months of the contract have passed, TrueTech concludes it now can make an accurate enough bonus estimate for it to be probable that the significant revenue reversal will not occur. So assume TrueTech estimates a 75% likelihood it will receive the bonus and bases its estimate on the most likely amount of 180,000. Okay, so 3 months have passed. We are going to record 90,000. That was the 3 months, 30K multiplied times 3 months. Record it as revenue. The journal entry for the final 3 months will look exactly like that other one that we had. Okay. The 50,000 from what was deferred, we've already gotten cash for it, and then that 30 every single month after that. Okay. And your T accounts will look like that. Okay. Um, the last thing in this video, we talk about the right of return. That is very important because sometimes sellers will guarantee like you can return as much as you want to. They sometimes call that channel stuffing. They'll just try to sell as much as they can right before the end of the year so that their income statement looks good. But if they've made those sales and they've said, you can return it back to us, or hey, we're just holding it in our warehouse for you until you're ready for it. Okay. If that product's not separated specifically for that, if that customer doesn't have any risk on that, it's really probably not a sale. Okay. It's probably something made up to make it look like a sale. Um, in audit, we'll talk a little bit more about that, how we would look at the beginning of the next year and like, hey, did the customer pay for it or did it get written off? If there was a big sale at the end of December and then there was a big write-off about the same amount in January, you would look at that as not being a sale. Okay. You would look at that as um, fraud, really, because they're trying to make their sales look better than they really are. Okay. That is all for, oh no, we got one more thing here. They said assume that TruTech sold 1,000 try boxes to comp stores for $240, and they estimate that the comp stores will return 5% of the try boxes. Then they're going to record sales revenue of 240,000, but they're going to have this estimated returns of 5%, 12,000. So net sales revenue would only be 228. Okay. All righty. That'll be all for this video. I will see you in the next one.